The stock boom turns to bust. An article in yesterday's Wall Street Journal that I want to share with you is pretty interesting, actually. You haven't seen a real bear market until you lost 90% of your money, says Andy Kessler. This is actually a full article you can read in the Wall Street Journal, I guess, if you have the proper link, which I will share with you. Because I don't subscribe to the Wall Street Journal anymore because they're far left lunatics on the news page. The editorial page is still good, but I'm not going to pay for the editorials because it's not worth it. Here's Walter Thornton, bankrupt investor. Walter Thornton tries to sell his luxury roadster for $100 in New York City, following the 1929 stock market crash. $100 will buy this car. Must have cash law on the stock market. Walter Thornton. Now, I did some research on old Walter. You think, oh, he must have jumped out of a building or something like that. Nope. He became famous looks like a millionaire investor, millionaire for back then, like a rich guy. And a modeling agency. We had like Rita Hayworth and Lauren Bacall, pinup girls. He specialized, especially during World War II. So I don't know if that $100 he got from selling his car jump started his modeling agency, but he survived just fine. He survived just fine. Just keep that in mind. But remember, must have cash. Must have cash. Must have cash. Must have cash. Equity doesn't put food on the table, my friends. Only cash does. All right, so let's read this. Even after last week, it feels like a lot of people think markets only go up. Buy the dip. Hold on for dear life. Feed the ducks when they're quacking. Stocks, bonds, SPACs, real estate, commodities, crypto, 200,000 non-fungible tokens known as NFTs. I don't even know what those are. With clips of LeBron James. Even GameStop is flying again. The sentiment is assets go up, cash is for losers. This hasn't been a bad bet. The March 2020 COVID insta-bear quickly returned to an insta-bull. So how do you know when to jump off a runaway train without being run over by one? I don't think I'm breaking any new ground here when I suggest that markets do go down. A lot. I was somewhat new to Wall Street, and the crash in 1987 took a 22% hit of the Dow. In retrospect, that's nothing. A partner at an 09 investment bank once told me that you haven't seen a real bear market until you've lost 90% of your money. In the mid-1990s, my partner and I ran a small-cap tech hedge fund. We experienced turbulence when the Fed Reserve Chairman Alan Greenspan said irrational exuberance in December 1996. And again, the summer of 97 when a currency crisis hit Indonesia, South Korea, and Thailand. We had built a portfolio of what we hoped for the next wave of high growth tech stocks. No one else believed it yet. Most names traded over the counter on the pink sheets, essentially. That means you're not on the New York Stock Exchange, not on NASDAQ, OTC, over the counter. Human market makers would set the bid and ask prices. On most days, you own the expected earning stream of an exciting future. Other days, you own a funny piece of paper. In 1998, there was another Asian currency crisis coupled with the Russian currency debacle. Few knew that the hedge fund geniuses at Long-Term Capital Management, LTCM, had levered up a bunch of bad bets. And when I say levered, I mean a Chernobyl of debt waiting to blow. And it did in September 98. I remember that well. Markets opened at 6:30 on West Coast and sold off hard. A flight to safety. Interesting. We ever seen or heard that before? Oh, yeah. Saw investors buying U.S. Treasuries and selling anything and everything with risky in their name. At the open, we were down 10%, and as more selling kicked in, the market makers were hit with a deluge of sell orders. They would simply lower their bids until sellers went away, which they never did. The sellers kept coming as long as I'm telling you, so reminiscent of 2008. It's crazy. We didn't sell a single share, but the prices dropped and dropped as bids went insanely low, and the sellers kept taking them. The Dow dropped by less than 5%, but our fund was down by nearly 40% by 8:30. I turned to my partner and said, well, you haven't lived until you lost $100 million before breakfast. Investors' money, but it's still a hurt. You see, it's not. He's losing a little. Investors are losing everything, but that's what they're paying him for. We gained back some losses as fears and apocalypse ended, but then the real bull market craziness began in January 1999 and ran until March of 2000. Dot-com names peaked in the early 2000s, but selling picked up in October and never really stopped until 2003, with the market down about a third. That's the overall market. Actually, the S&P 500 is down certainly by more than a third, 9, 11, and 22% respectively. NASDAQ got killed. Off the top of my head, what did NASDAQ do? They went from 5,000 to, can't remember. It was, let's just take a look here. Hold on a sec. NASDAQ fell from 5,000 to 1335. It dropped 3,600 points divided by 5,000. Dropped 73%. So over the course of that 3-year time, NASDAQ fell 73%. All right, so let's see. Remember that banker talking about losing 90%? Well, he was talking about the late 70s death march down, characterized by stocks going down in the morning and then going up in the morning, then down in the afternoon, as optimists quickly got stepped on by the pessimists. Sure enough, after 2000, high-flying tech names were down 90%. Many went to zero. Exactly. Hey, big boy. How do these bull bashes end? When the last skeptical buyer finally sees the light and buys into the dream that every car will be electric. Crypto will replace gold and banks. Say we overindulge on vertically farmed plant-based steaks while streaming Bridgerton season 5 before we hop on an air taxi for a flight to Mars. Those last skeptics, maybe already, convince themselves there's no longer any downside, and then boom, it's over. Bull markets need fuel. When the marginal buyer is done, there are no more greater fools to buy in, no matter how well companies actually perform. The dream is priced in, and firms can only meet, not beat expectations. For those lulled by today's bull market, remember that you own a piece of paper. Low-yielding U.S. Treasury bills and bonds are safe because they're backed by the U.S. government, by cash flow of tax dollars and the country's assets. Think land, not Fort Knox. Stocks are backed by expectations of future earnings, but if you overpay during periods of high expectations like today, then your downside is huge. Crypto is backed by a simple faith of those who proclaim it as a store of value. Even art and exotic cars and silly NFT tokens are backed only by the faith the wealthy will overpay for uniqueness. Faith becomes scarce when the selling starts. Yeah, so so fancy cars, the only value is what someone will pay for them. And if someone's going to pay more, there's value, higher value. If someone's going to pay less, lower value. So I want to see some of the comments, some pretty good comments here. Hopefully we can see them. What's up, big baby? Oh man, can we not see the comments? Oh, right here, because there's a couple comments I want to show you, which one was frightening, one was not. Lots of the sky's falling, no real answers. Anyway, I want to, okay. Explain to me, with the highest unemployment rate in many years, many local economies still locked down, yet a boom in the stock market and most other asset classes. Well, it's because inflating, I mean, that's what they do. They inflated assets for sure. Offload editorial, weak and unbalanced, mostly mindless. Yes, market goes down. Yes, some stocks are overvalued, not all stocks. All right, hold on a second. The problem is that the U.S. is now so levered that if the U.S. had to start liquidating assets to meet its obligations, it wouldn't be able to raise enough funds from its tax stream and land to meet its obligations. And maybe. Right here. Right, this is fantastic. This explanation, one bright young soldier from Goldman Sachs gave me, trying to be patient with me because I was his fiance's father, was that I had to understand there was a new paradigm. It was Thanksgiving dinner, 1999, and I was asking him how a .com a buddy of mine was flogging could have a market cap of over $100 million on $500,000 of projected revenue. This is such a good comment here. What's scaring me now is that the group of people can get together on social media and coordinate. See, I didn't use a church steeple cinnamon word. To pump and dump a zombie. And had the designated grown-ups that the regulators wanted to blame the targets of the planned heist. If we just reflect on those low moments in our lives, we'd want to end it, but we are buoyed by encouraged by all those high moments in life. Okay, same goes for the markets. Okay, let's see. All right, we could go back. All right, so you haven't seen a real, so here's another one. You haven't seen a real bear market until you've lost 90% of your money. That's what quoting the article. And you haven't seen a real world war until you lived through the 30s and 40s and saw 70 million people slaughtered. But it doesn't mean it'll happen again. So here's what's kind of frightening. After that war, the UN was created and the long peace began. That is 75 years and counting, and since the entire world went to war. It's not luck. People simply decide not again. The Great Depression was caused by a number of factors, but controls, the FEC, the SEC, FDIC, a number of laws promoting visibility and punishing bad actors were put in place during and after to reduce the chance of recurrence. Does this guarantee the herd mentality of our species will not drive us off of a financial cliff? No. But review the long prosperity that has resulted. Dude, it just boggles my mind. There are wars. There are people getting mass slaughtered. The whole thing's nuts. You never heard of Rwanda there, big guy? We still fell, what did we fall? From 2000 2003, like I said, NASDAQ fell 73%. S&P was down 9, 11, 22% respectively. Idiots, man. And you know what really expanded on the Great Depression was all the regulation by FDR. He's talking markets, and we sure have seen collapses during this long peace. I'll ignore the nuclear bomb drills of my childhood and all the regional sub-wars and instabilities. Yeah. All right, I want to show you, but there's one I want to show you here today. It's impossible for stocks to tank. Central bankers are determined to print whatever it takes to continue asset prices. Okay. I guess I'm not going to find it. About anyone have brain? Okay. Anyone with half brain knows that there are downturns in the market. No, it's not it. All right, let me see if I can't find this one. Right here is the best comment of the day. It's all part of the education process. Investors, particularly newer ones, are learning new terms by the week, and I'm not referring to attendees. I don't even know what that is. One currently not in circulation on Reddit boards or Twitter, but otherwise known to those that have seen the darker side of volatility, is something called no bid. No bid. I will pay nothing for your piece of paper. Dude, I'm telling you, people, no bid. I'll sell it. I'm not paying anything. Oh, what a great comment. Something called no bid. Well, I can always, markets up. In fact, I want to read you a comment I had on my own thing. Hold on a second. I can't remember, but there's a comment on my YouTube channel that says stocks always go up. And I mean, not all the time, but they said they always come back. That's what it was. Man, look, I don't know. You don't know. No one knows. But the idea that stocks always come back that frightens the heck out of me. So that's just ignorance of history for sure, because that's simply not true. Recency bias. In fact, I might have even been on that Wall Street Journal thing. I'm just not going to take the time to look at it. But let me do another video. If this is, what do we do? Because I think about this a lot actually, and I want to do another video on that. All right, thanks. We'll see you.